experience, restaurants, all those things that consumers don't want to touch or mingle with people right now. So you're going to see a lot of mall closings and a lot of change in the composition of the tenants.
Stacey, are you concerned about a significant second half slowdown in consumer spending? What Walmart said today, their sales have slowed what appears to be into August. We still have no stimulus. We have an election. Consumers could very easily get concerned about their finances with any change in the White House. How do you think about it?
Well, I think about the big getting bigger here. And that's what we're seeing. Walmart, Target, Amazon just keep gaining share as the customer goes for more one-stop shopping and bigger trips, perhaps fewer trips, but bigger trips. So maybe they don't shop around as much. Maybe they don't go to the competition as much. So I think the big guys will be fine no matter what kind of volatility we see in the economy. But at the same time, again, if those UI checks don't come back into play, and again, people just paid their taxes middle of July, there's a lot of money that's coming out of the pockets. Don't forget, a lot of people are getting a waiver on their mortgages and their rent. This stuff will all come to an end, and all the extra money in the pockets is probably going to dry up at some point.
All right, Stacey Widlitz of SW Retail Advisors. Always good to see you.
Good to see you guys.
Coming up next, the hottest zip codes in the country, and the results may surprise you. We'll be right back. It looks like home builders have been pretty busy this summer. Housing starts surged 22.6% last month, while building permits, a sign of future building, soared 18.8%. And there's more evidence today that Americans are migrating away from cities and looking for more space as we all work from home during this pandemic. Realtor.com is out with its latest list of hottest zip codes, and it's a lot of smaller cities or suburban areas. Here to talk about it in an interview you'll see first on Yahoo Finance is Danielle Hale, Chief Economist at Realtor.com. Danielle, good morning to you. As I look through this list, the thing that stuck out to me is a lot of these hot zip codes are in the Northeast. The West Coast used to be king. What happened here?
Yeah, that's absolutely right, Alexis. The East Coast really did well this year. There are a couple reasons for that. One, it's done a better job of keeping up with building and helps homes stay affordable. So on the West Coast and in California in particular, we've seen prices rise very fast. We see price increases in the Northeast, but not nearly as much. And the second reason is that this list is taken from a post-COVID period. So as I'm sure you remember, the Northeast, especially New York, was hit particularly hard by the coronavirus early on. But since that time, it's really recovered. And as the economy has recovered, so too has the housing market. And that's why we're seeing a lot of Northeast metros on this list this year.
Is city living just a thing of the past in this post-COVID world?
You know, Brian, everyone's worrying about that, but I don't think that's the case. Certainly, we have seen a migration away from the cities. Some of that may, in fact, be permanent. Already, there was a trend towards younger buyers as they're coming of age, settling down, maybe having a family, looking for more space. And that tends to lead people to look in the suburbs. So that was already happening. Now, with this extra time at home, trying to live, work, play, do schooling, all in the same space, people are even more interested in extra space. And so that's accentuated this ongoing trend towards the suburbs. That said, young people, empty nesters, there's a lot of people who will still prefer the city. It's got culture, it's got nightlife, it's got close proximity to everything. Young people starting out in their careers who want to be really close to the office so they can make a good impression. There are lots of reasons to stay in the city depending on what stage of life you're at.
Let's tick through some of these. Number one hottest zip code, Colorado Springs, Colorado, followed by, get this, Reynoldsburg, Ohio, and Rochester, New York. Why do you think?
So we've got broad representation of the US there, a Western zip, a Midwest zip, and a Northeast zip. Each of these areas have affordable home prices, and that's really helping to draw buyers in. And because buyers are interested in that affordability, homes in these zip codes are selling fast. So that's propelling them to the top of our hottest zips list this year.
Any big surprises for you here? I mean, other than that, I was surprised to see Rochester. I love Rochester, but surprised to see it in the top 3 hottest zip codes.
Yeah, Rochester has done a lot to revitalize its downtown area. So that is appealing to folks who are looking for an area that has big city-like amenities without a lot of the big city problems. You don't have as much traffic. And you've also got more affordability. So you can sort of have the best of the suburbs with some features that are a lot like living in a big city too. Rochester's got a major university. It's got major corporate headquarters there. So there's a lot going on in Rochester.
Danielle, why are some of these houses so darn cheap? You know, I look at the zip code, maybe a lake nearby, drop a fishing pole in there, catch some fish for dinner. I mean, it looks like somewhat relaxing places to go, but some of the prices here, wow, downright cheap.
Yeah, I mean, location has a big factor in how much homes cost, right? So if you're in a city where land is in super high demand, like New York City, for example, that's going to, necessarily make the homes more expensive in that area. As you go to these secondary markets, suburban areas, the land is less expensive. That enables builders to, get that land for a good price and put up a home, and it's much more affordable. And it helps keep the existing properties more affordable too, because there's a steady supply of new construction. In New York, the land's expensive. You've also got limited availability of land, so that helps push prices up. And so that's what enables these suburbs and secondary metros to stay affordable, even as bigger city major metros get more expensive.
All right, fascinating stuff. Hottest zip codes in the country right now. Danielle Hale, chief economist at Realtor.com. Thanks for being with us.
My pleasure.
All right, Jared, it happened. The S&P 500, now it seems anticlimactic, right? The S&P 500 at a record high.
Yeah, time to go home, Alexis. And I can't take all the credit here, but we did break that record intraday high at 33.93. And you can see here, this is today's price action, kind of coming down off that high. And we saw this with the Nasdaq. Sometimes when you make a new high, which hasn't been accomplished in some time, you sell off for a little bit and people say double top. I don't think that's going to necessarily be a double top, but sometimes we do retreat a little bit. Let's take a look at the NASDAQ 100 because the NASDAQ is leading yet again, and Apple is about break even, but Amazon is up 3%. And we were just talking about 20 minutes ago about a potential breakup, and that is what we're seeing. It is breaking to the upside. Hasn't taken out any record intraday highs yet, but it would be good for a record close. So we'll keep an eye on that. Facebook down about 1/3%, Alphabet up 1%. Looking at the Dow, full of earnings today, Walmart down 0.5%, and Home Depot, which did start out the day slightly in the green, is now down about 75 basis points. Boeing is down too, so industrials having a little bit of a stumble. But if we look at the sector performance today. Discretionary, which contains Amazon. In fact, I think it's up to about 25% Amazon. That is up 0.4%, followed by communication services, which is mostly Alphabet and Facebook and some Netflix in there as well. And then materials, those are all outperforming right now. To the downside, we have real estate, financials, and tech. Those are all underperforming. And we'll just take a look at a couple other heat maps here. We like to look at travel, kind of a mixed bag. It looks like some of the cruise lines in the green, but also in the red. Americans up about 1.5%. And finally, a look at the banks. Lots of red there, Alexis.
All right, thanks a lot, Jared. Coming up in the next hour, we'll continue to dissect this market and take a look at Walmart and Home Depot a little more closely after they absolutely crushed earnings estimates. More of the show right after this.
Welcome back to the first trade. It was a quarter to remember for Home Depot and Lowe's. In this just in, President Trump announced he is pardoning famed suffragist Susan B. Anthony. It comes as women celebrate the 100th anniversary of their right to vote. Now let's get to Inez Ferre for a look at several stocks. Inez, stimulus checks clearly have been spent on new appliances, maybe a new pair of jeans.
Yeah, that's right. Well, let's take a look at a couple of Dow components right now. They had opened at new highs and now have come down just a little bit. Walmart with its earnings, e-commerce sales for its latest quarter jumping 97%, adjusted earnings coming in as a beat, revenue also coming in as a beat. U.S. comparable sales up 9.3%. Average ticket, that was up 27%. You're seeing the stock a little bit under pressure right now, and maybe because of comments from the company regarding comparable same-store sales starting to return to more normal levels as stimulus funds have tapered off. Same-store sales in July were up 4%. So that's something to watch out for regarding stimulus. And then just taking a look at Home Depot, that stock right now down 0.8%, but Home Depot really benefiting from people staying at home, doing projects at home. Profit beat expectations, sales soared 23%. U.S. comparable sales grew 25% year over year. And the company declared a second quarter cash dividend of $1.50 a share. And then just taking a look at Amazon this morning, up more than 3%. Amazon says that it will create more than 3,500 new jobs across 6 cities. This will include Dallas, Detroit, Denver, New York, Phoenix, and also San Diego. This is part of a national tech hub expansion valued at $1.4 billion, that investment. And also in Manhattan, Amazon has acquired the Lord & Taylor Fifth Avenue building to put some of those jobs in there. Also in New York, Amazon has already more than 24,000 workers. So expanding jobs in some areas. And year to date, this stock is up 77%. We're looking right now at consumer discretionary, communication services, materials. Those are the sectors that are leading the gains this morning with a new intraday high for the S&P 500, Brian.
Amazon trying to crash the earnings day parties for Walmart and Home Depot. Come on, Amazon. All right, Nez, we'll check back with you later. Let's dive back in the markets with Quincy Crosby, Chief Market Strategist at Prudential Financial. Quincy, always good to speak with you. I feel as though the last time we talked to you, the market was hitting a new, close to a record high. It hits a new record high today. When does it stop?
When does it stop?
Yeah. How many more times can we hit records with no stimulus
plan?
plan?
But you know that even with the Dow, when we go to those big numbers, you go, you touch, you pull back, touch, pull back. And then suddenly, when you least expect it, it goes over and it stays. Today may be that day because we have to close. Remember, we've done this on the intraday, but we've got to close on it. And today, it has that feel. It just has that feel, given the numbers, given the housing related numbers, given the fact that last night with the Democratic convention, we saw a less left-wing progressive feel to that. We'll see how it goes tonight. I think the market will respond to that as well.
How much are the conventions, though, these virtual conventions, really having an impact on not just voters, but just on the overall market?
What's interesting is that those of us who work in the market, the practitioners, the portfolio managers, the analysts, are watching and paying attention to some of these words that would suggest that Joe Biden has been, quote unquote, taken over by the left. Words regarding tech, financials, energy, healthcare, certainly. I have colleagues who are focused on healthcare. They want to see if he even mentions the term public option, because the market is sensitive to all of these buzzwords. So far, the market hasn't been given anything in that regard. And then for tonight, which is important, AOC is given 1 minute. Everyone is interested in that. What is she going to say in 1 minute? And why was she only given 1 minute? We know overnight the progressives, the left wing of the progressives, have been very apparently unhappy with the way the convention is going, that they're not getting enough airtime. But this is good for
Quincy,
the market.
Quincy, Joe Biden has gotten a bad rap pretty much the whole year, basically tied to his tax plan. The thinking being he comes in, raises taxes, and stocks go right in the toilet. But just listening to you, it suggests that maybe President Joe Biden might actually be good for the country and for the stock market.
Well, for other reasons. All of the analysts now are coming out with their various portfolios, the Trump portfolio, the Biden portfolio. But the thing is, does he follow the Obama playbook? If you remember, Obama waited a while, waited for the economy to heal before he actually moved. Perhaps this is what Biden ultimately does, waits for the economy to heal completely before he moves with tax hikes.
What's your take? Yeah. What's your take, Quincy, on retail related stocks right now? I mean, Walmart and Home Depot off the charts, but there's concern that if another stimulus package doesn't happen in a timely way and more stimulus checks don't go out to Americans, spending is going to start to dry up. What do you do with your retail holdings right now?
Well, they've done so well that perhaps you take some profit there and redeploy, over to another sector, because it is clear that $1,200, the extra $600, fed into consumer spending. We saw it in the numbers. It helped create that V-shaped recovery, that initial V-shaped recovery, which actually was such a positive surprise for the market once those checks went out. Clearly, it can't be as strong as it has been. It's going to perhaps normalize. But nonetheless, I think it's done so well. Maybe you do take a little bit of profit. Now, the point is, if a stimulus package, I call it relief package actually is crafted and delivered, these shares can go up yet again.
Quincy, you mentioned Biden maybe perhaps takes a playbook out of former President Barack Obama. But do you think the market is saying, just reading the market, that perhaps 4 years of Joe Biden would be transformational, not unlike Bill Clinton?
Bill, what's interesting is the market did very well under Bill Clinton. The deficit didn't grow dramatically. I think it pulled back under Bill Clinton. And remember, before Bill Clinton came in, we had a white collar recession, one of the first we've seen in this modern United States. Those workers actually found jobs in the booming tech industry. So that changed, and then he was seen as a moderate Democrat, one that was not to the left, one who basically was right there in the middle, even to a little bit to the right. No one is expecting that from Biden, by the way. Nonetheless, based on last night, based on some of the commentary about Kamala Harris regarding her investigations into the financial industry, in which she didn't, destroy her ability to destroy some of the banks, they're looking more moderate than initially projected by the market. So we'll see, but we'll see how tonight goes and how the convention closes. The market is focused, and these are the analysts focused on any of those buzzwords, including taxes and what the plan is.
Hey, Quincy, you and I have talked before about small cap stocks, how they were underperforming. Are they starting to come back into favor here with investors?
Yes, they are. And in fact, one area that's becoming increasingly attractive is small cap biotech. You can see them doing well. Biotech in general has done well, but small cap biotech is getting a bid. And it's interesting to see. You want to see small cap perform. The reason is it suggests that managers, portfolio managers, pension fund managers see the economy climbing, gaining momentum, gaining strength. That is what the small caps will offer to the market. Granted, the tech names, the 5 tech names can push this S&P 500 over the top in a nanosecond. But what you really want to see is the small caps and broadening out of the sectors, pushing the market higher. It would be a commentary on those who believe that this economy has pulled out of the worst and is going to continue growing, albeit perhaps at a slower pace after the third quarter, which should be very strong, but nonetheless normalizing.
All right, let's leave it there. Quincy Crosby, Chief Market Strategist at Prudential Financial. Always good to speak with you.
Thank you.
All right, do stick around. On the other side of the break, we'll hit a Yahoo Finance trending ticker. All right, welcome back to the first trade. Watch out, Jeff Bezos. There's another billionaire catching up to you. One of our top Yahoo Finance trading tickers this morning is no doubt Tesla, after the company's shares surged 11% into Monday's close. Stock closed at a record high and boosted CEO Elon Musk's net worth by a casual $7.8 billion. Inez Ferre is back here with the details. Inez, only $7.8 billion. It's not bad. Pocket change.
Well, his net worth is now $84.8 billion. So let that sink in. He's the fourth on Bloomberg's billionaire index. He's now just $15 billion away from Facebook's Mark Zuckerberg. He's number 3 on the list. So now Elon Musk is number 4 on this list. And before him, of course, comes first Jeff Bezos of Amazon, Bill Gates of Microsoft, Mark Zuckerberg of Facebook. Elon Musk's wealth has grown by $57.2 billion this year. And if you take a look at Tesla's stock, it's up 346% year to date. Yesterday, it was up 11%. The stock has been on fire, to say the least. We had on Dan Ives yesterday on your show that increased his price target to $1,900 from $1,800. Well, that $1,900, it surpassed that this morning at the open. Right now, the stock is up about 2%. But really, Ives saying this is a tech company as compared to just an automobile company. Think about it's Battery Day that's coming up. Think about the growth in China, the accelerated growth in China. This stock has rallied year to date because of so many factors, including its deliveries, its financial results for the quarters, its speculation over inclusion in the S&P 500, its announcement of a 5-for-1 stock split. So much happening with this stock that it seems like analysts can't even keep up with it, Brian.
We'll get on that billionaires list, Inez. You just got to keep hustling hard, you know?
When it gets in the billions, 1 or 2 more, 7, 10 more, it doesn't matter.
Easy peasy, easy life. All right, thanks, Inez. All right, Epic Games, the makers of the wildly successful video game Fortnite, is looking for a hero of its own. It's asking a judge to stop Apple from blocking Fortnite on the App Store. Our tech editor, Dan Halley, is back with us. Dan, pretty tough situation here.
Yeah, this is part of the newly ongoing feud between Apple and Epic. Basically, what happened originally was Epic, in a rather calculated move, decided that they were going to add a workaround to their app Fortnite that allowed players to pay Epic directly rather than going through Apple's App Store payment system or Google's Play Store payment system, basically ensuring that Fortnite maker Epic gets all of the cash from those payments. And circumventing the rules of both app stores. Now, Google and Apple have taken Epic's Fortnite out of their respective app stores. And basically what's happening is Epic is looking to a judge to block its ability to stop Epic from allowing the games, Fortnite, to be in that app store. And it all comes down to basically what Apple is facing as far as antitrust investigations go, its app store payment system, and the amount of commission it takes from each company that makes a sale through the app store. So this cuts to the heart of the antitrust issue, and it really comes at a perilous time for Apple, because we saw they were before the House Judiciary Committee a few weeks back discussing this exact issue, and it really looks as though Epic set this up to happen at a time that would have the biggest impact against Apple. They've had an ongoing problem with the company for years. At one point, they didn't run Fortnite through Google's Play Store, allowing for users to download the app outside of that, but it ended up being more difficult for users, as Google purposely does. And so they ended up working with the Play Store. But now, obviously, the big issue is with Apple and iOS. They made that commercial kind of harkening back to the original Mac ads back in the 80s to kind of press their case that this is basically Apple acting as the top dog now and kind of stepping on the neck of smaller companies. And clearly, that's where this issue is going to end up taking place, as the courts.
Dan, what's the probability that this has a ripple effect on other app stores or for other gaming companies?
I think, the gaming community likely will rally behind Epic. They don't though, want to upset any kind of relationship they have with Apple right now, right? They look to Apple because, look, yes, they have a slight majority of users in the US, but globally, Google is the operating system of choice for the vast majority of people. But the reason why so many developers look to iOS is because iOS users spend more on their apps. So developers are going to go where the money is, and that's the App Store, or Apple's App Store rather, and that's why they're willing to put up with that 30% commission, 15% commission for subscriptions after a year. But I think this is the breaking point for a lot of companies where they're saying, look, if Uber doesn't have to pay a 30% commission on every ride that's booked through their app, if Seamless doesn't have to pay a 30% commission, or Grubhub doesn't have to pay a 30% commission, then why should we? What makes us different? And that kind of goes to the argument of Apple saying that apps are all treated equally, and app makers like Epic saying that's not in fact the case. We're paying despite the fact that we're an app and others that have apps aren't.
All right, Dan Hellie, thanks so much. All right, do stick around. On the other side of the break, we'll dive back into the start of the DNC. Welcome back to the first trade. Day 2 of the Democratic National Convention kicks off tonight at 9 p.m. Eastern Standard Time. Former President Bill Clinton and former Second Lady Jill Biden are some of the headliners for the virtual event, but people are still buzzing about Michelle Obama's comments she made last night.
Let me be as honest and clear as I possibly can. Donald Trump is the wrong president for our country. He has had more than enough time to prove that he can do the job, but he is clearly in over his head. He cannot meet this moment. He simply cannot be who we need him to be for us. It is what it is.
All right, let's break down the big night with Yahoo Finance senior columnist Rick Newman. Rick, definitely want to touch upon Michelle Obama's comments, but you know what? We just had Quincy Crosby on from Prudential Financials. He said the conference or the tone of the conference yesterday was more moderate as it pertains to Joe Biden's potential presidency. Would you agree with that?
Yeah, sure. I think so. I mean, Biden wants to position himself as the candidate who can get some centrist votes and perhaps some moderate Republican votes. And I think that's the reason we saw John Kasich, the former Republican governor of Ohio, talking in the convention yesterday. And, you know, what kind of struck me is I thought they did a pretty good job of making it look like the big tent they want it to be. So you have Bernie Sanders doing a better job this time around than he did in 2016 of saying, look, I don't agree with Biden on everything, but he's the man for the moment. And then going all the way over to Kasich and a few other Republicans. So you had far left people like Bernie Sanders pulling for Biden, and you had some sort of centrist Republicans pulling for Biden. That is what they're looking for. The real question with this convention and the Republican convention next week is, will they actually reach any persuadable voters? That's the bar here, not just to make all your fans happy. They really need to persuade the few people who are still somewhat undecided.
Hey, Rick, what did you make of Governor Cuomo's speech last night? He's getting a lot of slack for it today. He said some things about the virus, saying it was actually a metaphor for how weak our country is, that the coronavirus is not actually the illness. Kind of a little confusing, a little odd. I think he mentioned Trump once. He waited till the end of his speech to actually name Biden. What did you make of what he had to say?
Well, remember, all of these remarks are vetted because it's mostly pre-taped and it's all pre-approved by the Biden campaign. So the Biden campaign was fine with it. And but you're right. I mean, it was a little odd. And he actually is a little odd himself. I mean, he won plaudits for his news briefings when the crisis was really so terrible here in New York State and in New York City, because he was simply forthright about what was going on. Well, Trump was not. That was the time when Trump was saying, it's going to disappear. It's not, it's on the states, not on the federal government, and so forth. But, and of course, some people thought Cuomo should be the presidential candidate. So I think we saw a reason last night in that strange presentation for why he is not the presidential candidate. And he does have some off moments. And Trump is going after him on Twitter this morning, saying Cuomo is the one responsible for 11,000 deaths in New York State. So, more of the blame game about whose fault really are these coronavirus deaths.
All right, Rick Newman, thanks so much.
See you guys.
All right, amid all the pomp and speeches at the DNC, there are some policy choices that could impact all of us. So today we're taking a closer look at Joe Biden's tax plans. Garrett Watson, senior policy analyst at the Tax Foundation, has dug into the plan and joins us now. Garrett, good to speak with you today. One of the themes coming off the start of the convention yesterday, Joe Biden may push off tax increases, and perhaps he's would be a more moderate president. But you have crunched the numbers, and what your numbers suggest, he would be negative for GDP growth. Walk us through this.
That's right. Joe Biden's tax plan primarily aims at raising taxes on higher earners, raising taxes on corporations, and raising taxes on business and investment income for those higher earners. Overall, it raised about $3.5 trillion over 10 years. But we find that it does have an impact on economic growth. It would reduce growth by about 1.5% over the course of the long run, and would reduce jobs by about 800,000 overall. And so there really is a trade-off when it comes to these tax hikes in the form of reduced growth. And that's especially important right now as we're trying to rebuild the economy and get out of this economic crisis.
If we don't raise taxes, I mean, aren't we heading for a cliff once the stimulus bills all start to come due, and the fact that we're, printing money and our deficit continues to balloon?
That's right. Debts and deficits are going to be increasingly important to tackle coming out of this crisis. It's really important right now to be prioritizing targeted relief to the most vulnerable, given how high the unemployment rate is right now and the public health crisis that we're facing. But as that crisis recedes and growth resumes, we will need to tackle these rising debts and deficits that will require tough decisions on the spending side of things, but will also probably require a conversation about revenue. And we need to find ways to raise revenue through the tax system that also minimizes the economic harms. And that's going to be the tough trade-off that any next administration and next term will have to deal with, both to balance long-run growth while also raising the revenue we need to reduce these debts and deficits.
Garrett, what did you find in Kamala Harris's tax plan?
Harris's tax plan shares a lot of similarities with Joe Biden's in that it really does target repealing elements of the Tax Cuts and Jobs Act, the tax reform a few years ago, and does try to raise revenue from higher earners. Though she is more aggressive in doing so by pushing for higher tax rates and would raise a bit more revenue. The other thing is she's developed a very fleshed out plan for tax credits and providing relief for lower earners. And that's something we haven't seen as much from Biden yet. So looking forward to seeing how the campaign decides to take that plan and whether or not that becomes a centerpiece of his tax plan moving forward.
You know, for all his promises, Trump says, you know, he's not going to raise taxes. Will he have no choice but to do that if he's elected again during his next 4-year term, simply because the numbers aren't going to match up, and cities and states are going to need, and the federal government is going to need revenue source?
We are going to have a discussion about what forms of revenue need to come in to close debts and deficits and to rectify our budget situation. And that requires prioritizing places that we can raise taxes that minimize the effects on growth. Places like tax expenditures, broadening the tax base, looking at items like the state and local tax deduction or even the home mortgage interest deduction are probably the first places to look at. Those are expenditures that typically benefit the well-off. And would make the code simpler and more neutral if we were to reform them and minimize them. And of course, we also have to prioritize pro-growth elements, which also will help on the budget side of things. A big one, of course, is allowing businesses to fully deduct the cost of their investments when they make them, something that the Tax Cuts and Jobs Act made progress on, but something that we're optimistic that we can get bipartisan support on in combination with other tax reforms that will help with the budget situation.
Hey, Garrett, Rick Newman here. Biden also wants to essentially raise the capital gains tax, make it equal to the highest tax on income for, I think it's people earning over $400,000. Would that affect stock values, do you think?
We do think that it would have an effect on the economy, on the financial markets potentially, and on economic growth overall, though it's worth not overstating those effects. Generally, the economy being more international than it has been over the last few decades, that savings overall is not a problem for additional investment and to generate profits in the United States. And so while there is a growth effect from changing the rates overall, either higher or lower, the president, for example, would like to see them cut to 15%. The priority really should be on areas where there's going to be the greatest damage to the economy. And typically we see that through direct taxes on firms and businesses and through cost recovery items like being able to deduct the full cost of your investments in the tax code. And so while capital gains is important and something we need to talk about, and the tax treatment of savings overall can really be improved in this country, that's not a place where we think is going to be a particular harm or benefit moving forward, given the evidence that we have.
Biden also, he now favors that alternative corporate tax that Elizabeth Warren rolled out when she was running in the primaries. So the idea there is for companies that don't pay a lot of tax because they use different write-offs, but they do have a lot of income they report to shareholders to make them pay some minimum tax. But those write-offs are part of the legal tax code, and they're there as incentives to invest and do other things. Does that make any sense, that alternative corporate tax? And if you try to enact that through legislation, would you then have to change the incentives that it's actually trying to counteract?
You're right. The minimum tax proposal is meant to try to go after corporations that may post book income but don't have taxable profits. And one of the biggest differences between those two types of income is write-offs for new investments, which is something that we want to be incentivizing right now, not penalizing. Overall, minimum taxes are a very blunt instrument for raising revenue and reforming the corporate code. It would make things much more complicated, and to some extent would actually put some of these tax decisions in the laps of accountants in the financial community, something that's also concerning. So overall, it would be better for policymakers to think about ways to tweak the tax code directly in terms of taxing corporations, rather than going the route of minimum taxes, which is going to increase complexity and disincentivize the very kind of investment we need right now that's going to get us out of this economic crisis in the years ahead.
All right, we'll leave it there. Garrett Watson, Senior Policy Analyst at the Tax Foundation. Good analysis here.
Thank you.
All right, do stick around. Much more ahead on The First Trade. All right, welcome back to the first trade. Let's get right back to Inez Ferre for a look at several earnings reports. Inez, let's start with Kohl's here. Not a good quarter. There's no other way to put it.
There is no other way to put it. Its adjusted earnings per share came in at a loss for its latest quarter of 25 cents. That's versus $1.55 a share of earnings in the prior year. Its net sales declined 23% last quarter. Also, digital sales, though, those were up 58% year over year. But the company's gross profit margin shrank because of increased promotional activity and also because of shipping costs. The company did say that its inventory declined 26% versus last year, and consumers bought workout clothes, PJs, cozy apparel, toys, things that you would expect during the pandemic as people stayed in their homes. Taking a look at advanced auto parts, quite a different quarter for this company, up more than 1.5% right now. Its adjusted earnings per share increased 46% year over year. Net sales increased 7.3%. Comparable store sales increased 7.5%, its highest growth rate in nearly 10 years. And CEO Tom Greco said, without question, we benefited from a surge in industry demand in the quarter fueled by the government stimulus, unemployment benefits, and the impact COVID-19 had on consumer behavior in terms of how they repaired and maintained their vehicles. And then we're also taking a look this morning at Oracle, up more than 3% after a report that Oracle may be looking to acquire TikTok. This is according to the Financial Times. Oracle reportedly has held preliminary talks with ByteDance, the parent company of TikTok, and is seriously considering acquiring its operations in the US, Canada, New Zealand, and also Australia. Now, Oracle, of course, would be competing with Microsoft, which has said recently that it's in talks to potentially acquire TikTok. Brian?
All right, states are asking pharmaceutical giants, including McKesson, AmerisourceBergen, and Cardinal Health, to pay around $26.4 billion to cover some of the damage caused by the opioid crisis. Yahoo Finance's Alexis Keenan joins us now. Alexis?
Hey, Brian. Now that report is coming from the Wall Street Journal. These are state attorneys general who they say are making a demand for that $26.4 billion from those opioid distributors that you mentioned, McKesson, AmerisourceBergen, Cardinal Health, looking for $21.1 billion from those companies, along with manufacturer J&J at $5.3 billion that made some of the opioid supply, though the distributors represent most of the distribution of opioid products in the U.S. Now, these settlement talks, they've been ongoing for well over a year, but reportedly stalled because of court delays due to COVID-19, not being able to keep the courts going. These U.S. states, they are among, though, 3,000 or so government plaintiffs against opioid manufacturers, distributors, also drugstores. They are plaintiffs along with counties, cities, localities across the country that have all sued. But these talks, specifically reported by the Wall Street Journal, they relate to these 4 particular defendants.
Alexis, I know there were a new round of trial dates announced. Do you think that we can expect a settlement to be reached before these ever actually make it to trial?
Well, that's kind of the idea. And the judge that's overseeing the multi-district litigation in Ohio, where the cases are consolidated, just for the point of getting all the pre-trial activity under control and kind of in a more efficient way to handle the cases, he has certainly pushed for settlement. And every time a trial date is set, it definitely spurs some settlement talks. Now, these companies that the Wall Street Journal reported on, they rejected, they had offered actually an $18 billion settlement to 21 states back in February. The states rejected that one. But look, New York's trial, that one was delayed. It was supposed to happen in March, but due to the coronavirus, that's been delayed. But upcoming are Ohio and West Virginia, 2 states that were hit really hard by the opioid epidemic and still are hit quite hard. Their trial is now set for October, so we certainly should see some activity.
Alexis, this could be a pretty big financial hit. $26.4 billion is no chump change. I mean, McKesson, AmerisourceBergen, and Cardinal Health, they have good, pretty decent financial statements, but that would sure take a chunk out of the bottom line.
huge chunk, and among those, J&J, of course, the big dog there with the market cap of $392 billion. The others between 15 and 25 billion for the distributors there. But what was really interesting is yesterday, New York Attorney General filed in a separate case, and that is the bankruptcy proceeding that's happening in the Southern District in New York for Purdue Pharma. And of course, because of their bankruptcy, they're kind of extracted from these other litigations that are still ongoing, and it's being handled in the bankruptcy court. In that filing, the US states across the country, with the exception of Oklahoma, they said that they had totaled the amount of just the financial damages, the financial costs that this epidemic has made between 1999, when they say it started, until 2018. And they put that number of financial damages at $2.5 trillion. So we're not in with a B anymore for billion.
All right, Alexis Keenan, thanks so much. All right, do stick around. On the other side of the break, we'll have a first on Yahoo Finance with Vacasa's CEO, Matt Roberts.
Travel may have been upended by COVID-19, but the vacation home market is exploding. Vacation rental platform Vacasa is out with its 2020 Best Places to Buy a Vacation Home report. And joining us now for a first on Yahoo Finance is Vacasa's CEO, Matt Roberts. Matt, good to have you on the show. Before we get to this report, I just want to talk about business for Vacasa right now. I understand you're seeing 35% increase in rental real estate transactions in some markets this year. Why is that?
That's right. Well, first, thanks for having me on. The same drivers that are making vacation rentals the preferred accommodation are also getting people to think, I'd like to actually own a second home that I can use as a vacation getaway. And so the same drivers are in play here. And yeah, we're seeing big increases in transactions, and supply is tightening up as well.
Matt, you just took over Vacasa in February. What changes have you had to make to the company because of the pandemic?
Well, it's been a wild ride for sure. The travel restrictions and the quarantine situation really had the travel stop in total. But then when we had thought that there would be a lot of pent up demand, and boy, was there ever. We just came booming back. And we're actually at record volumes right now. We're expecting a really good back half of the year as well. So I'm excited that we were able to reinvigorate the business and get charging ahead for the growth that we're expecting throughout the rest of the year.
what's happened to some of the prices that renters are able to get for their vacation homes right now? I mean, are you seeing sort of bidding wars for these properties, or people who are looking to rent able to really get a premium for their residences because people just need a change of scenery or they need to get out of dense cities?
Yeah, you hit it. I mean, people are really wanting to, they still want to be in a home. They just don't want to be in their home anymore, right? They want to change the scenery. And you couple that with the freedom that people have now to actually work remotely and then add distance learning for the kids. And it really sets up a good situation for homeowners that are renting out their properties. We're definitely seeing good rates for them, but also, and as importantly, really high occupancy levels as well.
Who is the customer here?
Well, it's really people that are, there's partly investors and there's some people that are looking at